So yesterday we were able to cover some prerequisites on Forex trading. And I'll be making a recap on what we covered yesterday. So Forex trading is all about buying and selling of currency. So one of the key parts of Forex trading is understanding that it is a Forex exchange market. And when we say something is foreign exchange, it means it has to do with correlation of two currencies or two products. But in this sense, we are dealing with foreign exchange. That means we are dealing with countries to countries, and we are dealing with their currencies. So the currencies a particular country is using determine how we are going to make money in this Forex trading. So for instance, here, this is Euro currency. This currency belongs to the European country. While we have another currency here, which is US dollar. We all know this belongs to United States. So these two countries, when they combine both of their currency together, we have what we call a currency pair. And that currency pair is going to tell us a story, what is going on between these two countries. So if Europe is developing well and they are having good infrastructure or they are having a good day, then it means this euro will be strong at that particular period. Within that particular range of time, euro will be very, very strong. And the same thing applies to USD. If the country that uses this currency begin to have like a bad day or a bad story or a bad news, this particular country begin to lose shape, begin to get weak. So now we can say, for us to make money in this market, we have to know which of this currency is weak and which of this currency is strong. The same thing happened to USD JPY. So for me to buy or sell any of these currency pairs, we call them currency pairs, I have to know which of them is weak and which of them is strong. So those are one of the key things we did yesterday. Then we move to what we call trend types, type of trends. If you have looked at any financial market, you see market goes up and goes down. And it doesn't just goes up or go down, it also goes sideways. So there are three things the market does or frequently. The three things the market does is it goes to the upside, it goes sideways, then it goes to the downside. So this sideways market is what we call a ranging market. And 90% of time the market ranges. So if market ranges more often, that means we need to understand that we can buy, we can sell in the market. So what we need to lay more emphasis on now is knowing that market can go up, market can go sideways, and market can go to the downside. Okay, so let's continue. So this is an example of a uptrend market. Look at the way the market is going to the upside continually. Continue to go to the upside. So as long as the market continues to move to the upside, we are having an uptrend. And you can see a line. I even put a line below this drawing. And when market broke below this line, the market starts reversing to the downside. And we call it a downtrend. But look at what it was doing when it was going to the uptrend, upside. It pushed with a long leg, then it corrects back. What this corrects back it does is what we call a correction. And after this correction, it pushes again, which we call an impulse. And it corrects again. And it pushes again impulsively, and it corrects again. This is how the market moves. Any market, either is a stock in Nigeria or outside the country, or even if it's a stock in a stock like agriculture or cryptocurrency or foreign exchange, whatever it is, this is how all of them move. So it has to have this long leg, this short leg, this long leg, this short leg, then this long leg, this short leg. Then when it's able to break a line like this, you have what we call a reversal instantly in the market. So let's progress. So then we mentioned the fourth things we need to understand in the market is candlestick. This previous chart, you will see there are different series of candlesticks that makes up this trend. Look at this long trend that happens. This trend can happen for a whole day. But there are series of candlesticks that are inside that makes up this trend. So a candlestick is more just like a normal candle. If you take a normal candle and you put a stick inside the candle, that is what you get. So when the candlestick is green in color, it is a bullish candlestick. It means buyers are present in the market. And if it's a red candle, it means it is a bearish candlestick. Sellers are present in the market. So when you're having bullish candlestick, you should be looking to buy. And when you're having bearish candlestick, you should be looking to sell. But we don't want to look and confuse ourselves or contradict ourselves too much. We only want to look at two types of candlestick. And the two types of candlestick is what we call candlestick formation. We call them candlestick formation. So when I mean candlestick formation, I mean I'm looking at a kind of candlestick pattern. I want to see markets show me two types of candlestick pattern. And when market show me those two candlesticks, I know for sure what the market is going to do. Yes, so okay, so this is foreign exchange. We started some things yesterday when we spoke about Forex trading. And one of the things we mentioned was Forex being transactions that occur between countries and countries. One country and another country. So in this state now, we have something like this, euro, and we have US dollar. And on this euro and US dollar, there's something that is happening between this euro and US dollar. Their currencies are present in this. We are using the euro PF, and we are using the USD currency. So we can see that this country has a currency called euro, and this country has a currency called United States dollars. So when you join these two currencies together, you have what we call a currency pairs. And for us to make profits or transact in this foreign exchange, we have to be able to trade in what we call pairs. We can only trade in pairs. So in this instance now, we have euro, US dollar. And in this instance, we have US dollar, Japanese yen. So this belongs to Europe, this belongs to United States. Why this belongs to United States and this belongs to Japan. So it means for us to trade this successfully, we need to understand what is going on in this country and what is going on in this country. what is going on in this country and what is going on in this country. And for us to further understand that, we need to know what they call a trend. And this is where a trend comes in. The market can only do three things. Either it buys, it goes sideways, or it sells. Those are the three things the market does. And when it's going down, it means there are a lot of sellers that are selling at that period. That means the market is in a bad shape. The economy is going down, it's going bad. And when it's going up, it means the economy is doing well, or the currency is doing well. So, if we look at this chart now, we can see we have different kind of small green and red stuff inside it. This red and green stuff you are seeing is what we call candlestick. And what is candlestick? Candlestick is like a normal candle, and you now put a stick inside it. So when you have a green candlestick, it means it is a bullish candle. It is a buy candle. And what does a buy candle does? It goes to the upside. And when you have this red one, it means it is a bearish candlestick. It is a selling candlestick, and it means there are sellers in that candle. So the only thing the green candle does is it takes this chart to the upside, and the only thing the red candle does is it takes this chart to the downside. So whenever you have this red candle, you see it continuously take this candle to the downside. But when you have the green candle, it takes to the upside. So the more green candle you have, the more the trend starts going up. The more red candle you have, the more the trend starts going down. And there's a tool we usually use. Look at this tool I put here. This is what I call a trend line. That red line below. When we put that red line below each of this, below this candle, if it breaks below it, it means an uptrend can instantly change to a downtrend. And before markets move to the upside, there's two things it usually does. It makes an impulsive move. It corrects. It makes an impulsive move. It do correction. It makes an impulsive move. It does correction. And that is how it does. So this took us to looking at each of these candlesticks inside this. The candlestick inside this that is making us this uptrend and this downtrend. If you go further deeper inside the candlestick, there's just only two candlesticks we are interested in, and this is the candlestick. We call the candlestick bullish engulfing. We want to look at two candlestick formation. When you have a red candle and you have a green candle next to it that engulfs the entire body of this candle, it is what we call a bullish engulfing. And the only thing this bullish engulfing does is when market is coming downside, any market you see at all, any stock, any cryptocurrency that is coming downside, and it got to a particular level, and you have this candlestick formation, the market is going to change to the upside. The opposite of a bullish engulfing is a bearish engulfing pattern. So this is an example of a bearish engulfing stick. You have series of candles going up, and suddenly you have what? This bearish engulfing. So the bearish engulfing, you have a bullish candle first, with a buy candle, then you have a bearish candle subsequently. And this bearish candle is what? It is engulfing the entire body of this candle. And when it's engulfed the entire body of this candle, the market will what? Sell to the downside. Then, if you look at the charts again, the second candlestick you want to look is what we call rejection candlestick. Rejection candlesticks. So what are rejection candlesticks? Rejection candlesticks are candlesticks that looks that looks like toys. When you look at children toys, those toys that they usually play with when they were little, that means those toys are like toys that look very small like this. They have this kind of body, very small. You see, they are different from this candle that has a big red body and a big green body, but they just have this small body. This is what we call a rejection candlestick. So we have this type of rejection candlestick called the doji, and we have this type of rejection candlestick called the hammer. Look the way this one looks like a hammer. We have this rejection candlestick called a shooting star. And remember this again, this is an engulfing candlestick we spoke about in the previous class. A engulfing candlestick, something like this, still the same here. So these are the candlesticks you want to only pay attention to. The doji, the hammer looks like a hammer. The shooting star looks like an inverted hammer when you turn an hammer upside down. Then the engulfing candlestick, which we spoke about. So today we are going to be looking at creating. We need to before you can trade, you use your what we call an MT4 to trade. MT4 to trade. So we have MT4 platform. This platform you are seeing here is currently an MT4 platform. We call it MetaTrader 4 platform. So what you do with this platform is what? You use it to what? To buy and sell. You use it to what? To buy and sell. As much as we have a trading platform, we also have what we call a brokerage platform. A brokerage platform is what we use to connect to the financial market. The financial market is where all the money is residing, where all the countries are transacting and business are going on. And if you can connect to this financial market and you know how to trade this market, you can make much significant amount of money, because there are transactions that happens up to 6.6 trillion naira every day in the market. So even if your job or what you are competent to do on this market is to even take $100,000 every day, it is available for you. So before you can connect to the financial market, you need what we call a broker. At this top of my account is what we call, you see IC market here. So this is what we call a broker. But this platform entirely is what we call a trading platform, which is our MetaTrader 4. So first of all, we need to have a broker. Then second of all, we now need to have a trading platform like this. So we will now link our trading platform to our brokerage platform. That is how it works. So let me show you, for instance, how we quickly move. So let me show you, for instance, how we quickly connect to our broker account. So the one of the broker we want to connect to is what we call IC market. So once you go to IC market, search on IC market, you should be able to have your broker. This is the broker here. This is the broker you are seeing here. So when you log in, you click on this place, you go to accounts, you click on accounts, then you click on MT4, you go to MT4. Then when you get to MT4, you click on open new demo account. Yes, we select raw spread US dollar, and the leverage should be 1 to 1,000. Then this is the account you want to get, the fund you want to get. So if you want a $200 account, you click on 200 and you proceed. So what we just did now, we have successfully opened a demo account. This is the demo account here. you have successfully opened. So, and next thing we now need is to go to our Play Store. You go to your Play Store, you search for MetaTrader 4. Look at it here, MetaTrader 4. Then you click on install. So for me, I already have MetaTrader 4, so I can open it in my phone. So this is my MetaTrader 4. This is how the app looks like. MetaTrader 4. So first thing I see on this is my currency quotes. That is my currency quotes. So as I mentioned initially, and yesterday we mentioned a lot of things. So one of the things we mentioned is market trades in what? In pairs. The currency trades in pairs. So it trades in pairs. So one of the pairs you are seeing here is AUD US dollar, Euro US dollar, GBP US dollar, USD card. Yeah, you can see USD card. You can see USD card. So let me go back here. So we have our quotes here. So for instance, this is Euro US dollar. It means Europe and United States dollars. So once I click on this Euro US dollar, it's going to give me the chart for Euro US dollar. And this is the chart for Euro US dollar. You can see what we just talked about. But in this instance, the bullish candle, the buy candle are the blues, while the selling candle are the red ones. Forget about those other lines inside. I'm going to explain those other lines for us. Yeah, but let's focus on the candlestick inside. So each of these candlesticks, look at this candlestick here now, is behaving it's behaving like the bearish engulfing we talked about. So on this, if you click this place, you can see the accounts, my account. If you click on this place, you can add different type of accounts, like cryptocurrency. If you want to trade a stock, you are going to see those stocks here. If you want to trade agriculture, like soya beans and gold and the rest, you see all of them here. You can see different kind of commodities that you can trade. You can add them to this place. Then this is the chart area where we buy and sell. Yeah, this is the account where you see your account, your equity, your free margin. So your balance is the amount you currently have in your account. Your equity is your profit plus your balance. Your free margin is what you have left to trade with. There's a level you get to that if you overtrade, you might not be able to open more trade again. So that is your free margin. Then we have history. This history shows all your transactions, all your profits, maybe daily profit or weekly profit. You are going to see them here. Yes. So when we come to this place and we click on this chart side, and we click on this plus sign up there, here you have where you buy and sell. You can see two buttons at the bottom, buy and sell buttons. Okay. So this is where you click buy and sell. So before you click this buy and sell, you should be able to know, okay, is the market going to the upside? You click a buy. And is the market going to the downside? You click a sell. And there's one thing important before you start clicking a buy or a sell. You need to look at this up. This place is what we call lot size, or we call it volume. It means if you want to connect with the financial markets, you want to trade with the financial markets, you should be able to know the amount you want to participate with it. So for a starter, we use 0.01 to participate in this market. There's a level you get to, you can use 0.1, you can use 0.5, you can even use 1.0. We talked about most of this thing on yesterday class. So you can use 0.01 as a starter. So it means you are risking a very small part of your accounts to communicate with the market. So in this sense now, you can risk very little and you can be able to make money. Get. So when you open your trading account, your broker account, you can see your broker account has what we call this ID here, 44920-303. You're going to copy that and you open this, enable this password also. You copy this password and look at the server below, IC Market SC Demo 04. You copy all of them or you take note of them. Click on this line, click on Manage Account, click on this plus, log in to an existing account. So you search for IC Market SC Demo server. This one here, the server, you search for that server, SC Market SC. You search for it here, this is it. Once you search for it, you're going to see it, you click on it, then you copy your ID and you paste it there. You copy your ID, you paste, and you copy your password, so you paste. This is how we connect our trading accounts to our brokerage accounts to our MT4. So that is how we connect our brokerage account to our MT4. So currently now it's connecting. It said no connection. Before you know, it's going to bring connection. So this is, once you're able to connect this now, your account will now be able to sign in into this broker. It means you can fund your broker and you can withdraw from your broker. Anytime you make money, you withdraw the monies from this IC Market broker, and whenever you want to do anything, you do it on this IC Market, and you can now trade with this your MT4. That is just what it means. So for you to now buy and sell in this market, for you to properly buy and sell in this market, you need to know how to use what we call a trend line in this market, and chart patterns. A trend line and chart pattern. So all you can see in this your, everything you can see in this your MT4. This MT4 I'm showing you, this is a PC version. The one I showed you on the phone is the phone Android version. So it's still the same thing they are doing. So if you want to understand what is actually happening inside this chart, you need to understand some basic patterns and how to use trend line. So a trend line is a tool that you always see inside your MT4. I'm going to show you where to get it. So in your MT4, this is where you can see your trend line is up here. It's a tool that tells you where the market is. So if I'm able to know where this market is the market, you see this market is bouncing at this area. It's bouncing whenever it touches this red line. But when it breaks above this trend line, it started going to the upside. So there's a rule that happened that makes this market start going up. And that rule is what we call support and resistance. Support and resistance. So whenever market breaks any line like this, it goes to the other direction. But let me show you how this trend line really works. So when the market is coming to the downside like this, it bounces the third time on this line. This is my trend line. I mark this place, this candle touches and went up. I also intersected with this place, it touches and went up. Then the third time that is coming to that area, I'm anticipating that the market will go up from that area to the upside. That is the idea. The same thing when I'm selling too. If the market is coming to the downside, something like this, I start marking the first area it touches, the second area it touches, then the third area it touches. Immediately you come to the third area. The third area, this is the first area, the second area. When it comes to the third area, I anticipate on that third area to sell from that third area. So this is where I put my trigger for sell. So I'm buying here and I'm selling here. So this low you are seeing here, the market touch multiple times, what we call a support. Why this high you are seeing here, where market touch multiple times, is called a resistance. So support is like a floor in a room. When sellers, a lot of sellers, let's assume these are many selling candles, a lot of red candles. And remember, when you see a lot of red candles, it means people are selling. A lot of companies are selling their stock or selling that euro US dollar. They are selling that commodity. So when price gets to a particular level and bounce off that level consecutively, it means that level is a support. It's like a floor. Market cannot go below it. The only thing market can do is to go higher. That means a lot of buyers are waiting in this support. The same thing happens here. When market goes up, come down, goes up, sellers are in the market pushing it down consecutively. The third time market comes to that area is where we are looking to sell. And that area is what we call resistance. And the reason why markets sell from that area is because a lot of buyers are waiting in that area to sell. So we want to move with those people that are selling. So this is just one of the key fundamental things that you need to understand about why the market sells from where it sells and why it buys from where it buys from. So there are patterns that you need to understand, what we call chart patterns. So if you look at the market very well, you start seeing these patterns that happens every time inside there. And this pattern gives us idea where market is going to buy and where market is going to sell. So one of the first patterns is what we call a descending channel. We call it descending channel. We call it descending and ascending channel. So this is a descending and ascending channel here. And what does descending and ascending channel does is, this is how it look like in the market. You see a descending channel look like this. The market comes down. I'm using a line in this scenario, but there are series of red candles. Remember, when market is going down, there are series of red candles. And when it goes up, there are series of buy candles. So when you have something like this, so there are a lot of candles. Let's say this is 100 candles that makes up this line, 50 candles that makes up this line, 20 candles, 10 candles, 5 candles, and so on, 1 candle. So what we do now is, when you have this thing, you see a pattern like this in the market, you're able to spot what this kind of thing, you should be able to mark it. You take your trend line and you mark the top of these candles together, and you mark the lows of this candle together. The lows of this candle together. You mark the lows of this candle. The pattern you just saw here, if you go to the chart, you are going to see a lot of them. And how do you trade this pattern? Is you are waiting for markets to break out of this line. This is your trend line. Once market is able to break out of this your trend line, then the market will start going to the upside. It will start going to the upside. And this is what we call a descending channel. And sometimes this descending channel can also look like this. You mark this with your trend line, and you mark this with your trend line too. So when the market breaks above this area, this is the buy trade. This is where you go for your buy. You know, market will start going to the upside from this area. And that is a descending. Then how does an ascending channel look like? So an ascending channel will look something like this. An ascending channel is opposite of your descending channel. So an ascending channel will be going to the upside. It's a bullish. Market begins to do this. So you mark these highs, the tops of this candle, you mark all the highs. The lows of this candle, you mark everything, you join them together. Get. So market is going to the upside. You see a chart that is going to the upside and start doing this pattern. Immediately it breaks below this your trend line. This is the line. The market will start going to the downside. So we can now sell at this area. And this is what we call what? A descending and ascending channel. So the second is descending channel. Okay, so all right, so the another pattern you need to know is what we call, we'll be looking at this pattern in the next class, looking at them on the main chart so we can understand how they behave inside the real chart. So another pattern you need to understand is what we call the head and shoulder pattern. So this head and shoulder pattern, it looks like just the way the name inscribed, like a head and shoulder. So it has a left shoulder, it has a head, and it has a what we call a right shoulder. So let's say these are series of candlesticks that makes up this head of shoulder. Let's say it's 100 candlesticks that made up this head of shoulder. So what does this signify on the chart? If you see something that looks like this head and shoulder in the market, it's a reversal. It means that if the market has been going from down for a long time to the upside and you spot this head and shoulder, you can sell immediately. It starts giving you this right shoulder. So when it gives you this right shoulder, you mark this right shoulder and you wait for price to come back to this right shoulder. When price comes back to this right shoulder, what it does is this right shoulder serves as a resistance and market will fall immediately from it. So it means we can now what? Sell in this area. This is how we can sell in this particular chart. The opposite of head and shoulder is what we call inverse head and shoulder. Inverse head and shoulder. So the opposite is like having a left shoulder and a right shoulder. So let's say the market is coming from a downtrend. The market is coming down. It started giving you this head and shoulder. Once it starts giving you this head and shoulder, it's telling you that market wants to reverse to the upside. So when it gives you this right shoulder, what you need to do is to mark the right shoulder, wait for price to come back to it. When those candles still come back to it, this is where you can take a buy to the upside.
Depends. Depends.
So another candlestick pattern that we need to understand that is happening in the market is what we call the rising and falling wedge. Rising and falling wedge. So we have the rising wedge, and we have the falling wedge. So how does the rising wedge contribute to the market? So we say we usually have bullish trends and bearish trend, a buy trend and a selling trend. That's a uptrend and a downtrend. So in an uptrend, rising wedge is responsible for an uptrend market. So you see something like this, series of candle goes up, and you will now see something like this in the market. Something like, look like a sideways market. You see a sideways market like this. Different small candles. So if you are able to mark these highs, join the top of these candles and join their lows together, immediately market break above that your line you join, you can buy at that instant. You can buy here. It means when you're able to buy, you are going to make money. Market will continue going to the upside. Whenever you see this rising wedge. And how do you trade the opposite? When market is coming to the downside, let's say the trend is coming to the downside, and you have this falling wedge. And you have this. So this is what you have. You join the highs together, and you also join the lows together. Immediately market broke below it. This is a signal for sell. This is how you know if the market will continue going to the downside. So in this case now, you can now sell from here, and market will continue going to the downside. So this is a what? A rising wedge, and this is a falling wedge. Then one of the last pattern I will show you is what we call the double top, and the double top, double bottom. So what does this pattern does? When you look at the chart, whenever you see them, you'll be seeing them at the low of a chart. Any chart will open. At the low of the chart, you'll be seeing this pattern. They are responsible for reversing the trend. So if you are currently in a selling market, the market is going down, has been going down for a long time. Immediately you see this pattern that look like this. You saw this thing at the bottom. When the market is coming down, you saw a bottom that touched themselves 2 times at the bottom. This is what we call a double. This is called a double bottom. This is what we call a double bottom. So market touches themselves. You are able to mark this, join these 2 lows together. It means it's a double bottom. So what it does is it reverses trend to the upside. So all you have to wait is immediately break this line. You can take a buy to the upside. And now you have, if you have a trend going to the upside already, and you have this, what we call double top. So you need to join these highs together, and also join, and look at this middle, this low. Once market is able to break this middle, then you can sell immediately. And its price is going to go to the downside. And this is what we use. These are the 4 major patterns we use in the market to understand how the market is moving. This is basically what a lot of people are looking at. So since we are able to understand what they are looking at, we can make more better decisions than them. So this is double bottom, rising wedge, head and shoulder pattern, inverse head and shoulder pattern, and we have descending and ascending channel. Yeah. But one thing is common that you can use to identify all these patterns is what we call your support, your trend line. Yeah. Your trend line. And if I go back to my MT4, you see I use a trend line in this place. I use a trend line. This is my MT4. So don't mind my MT4 the way it look like. Yeah, it's a new. So all these are candlestick. It's a new setup. The candle, don't worry about the color of the candle, but it's just telling you the market is going up and the market is going down. But you can see something that is common in this candle is on this particular chart, this euro US dollar, you can see market is going to the upside, isn't it? It is going up. How do we know it is going up? If we carry our trend line, this is our trend line here on this market, and we start to mark the lows, we start to join the lows of this, that's the bottom of this candle, we see that market is going to the upside continuously. So this is how we know this is an uptrend. Yeah. So this place I'm going to pick my trend line on this my MetaTrader 4 that we downloaded in our phone is where we call our toolbar. You can see different tools in this place. We have the trend line, we have the horizontal line. This is what the horizontal line helps us to mark area in the market. Yeah. So and at the right of this our chart, we have what we call prices. You can see prices. These are prices here. It means these are prices, these are quotes, these are foreign exchange quotes that we are buying or selling this particular currency pair, euro US dollar. And at the bottom you can see dates. These are the dates where it means the time you are particularly trading this market. So we can go to previous, as this market is, we can even go to 10 years ago to see what it has done 10 years ago. So the area here are for tools, but one of the tools we use more often is the trend line. Yeah. Tomorrow we'll be using what we call indicators. And to locate indicators, you have to go to insert indicators. You can see we have different indicators here. But when we're talking about that today, it's just the trend line majorly. Yeah. So trend line helps us to identify the trend of the market. So look at this market. I can mark this high and this high together. This high and this low. And I can mark this low and this low together. So this is the pattern the market is giving me. It's telling me that if market breaks this high, immediately market breaks this high with this candlestick, what did it start doing? It's going to start going to the upside. And what did it start doing? Immediately broke it, it started going to the upside. So this is how I use my trend line. I can mark different area in my chart with this trend line. And I'm waiting for market to break it. So even if I extend this market to this trend line to the upside, because it is bouncing on this trend line, market is bouncing on this trend line. And if market break it with a candlestick, the market is going to automatically change to the downside. And these are rules we are using here, basically. So our trend line, we need to use the trend line to mark 3 places the market touch. If the market touch this area, it touches this high, it touches this high, and it touches this high, the market will reverse from it. If the market touches this low, and it touches the third time, it's going to bounce from it. If it touches here 1, touches here 2, it's going to bounce from it. That is how market works. Get. So it touches here 1, touches here 2, touches here 3, it's going to reverse from it. That's the idea we use. Touches here 1, touches here 2, touches here 3, is going to reverse from it. And this, for you to know how to make money from this, you need to understand pips. So it's pips, you know when you are making profits and when you are making loss in the market. So once you can see I have an IC market account connected to this, you can see Joseph. So I connected my IC market account to this. And to connect that on your PC, go to File, Open an Account, or you can click on Yes, Open an Account. Then these are different IC market accounts here. I can pick from it, just same simple process. We can zoom in our chart from here. If you want to see the candlestick better, you can reduce to see better, to see far distance, like see them very little. Yeah. So at this bottom, you can see your trade account. This is your trading account. This is your account history. Account history, how much you are making, and you can see other things here. Yeah, so your trade account, here is where we connect our account. Here is where we go to, for instance, we want to add an indicators, which we'll not be adding today. Indicators, we go to insert and click on indicators. Then these are indicators. Majorly indicators are just like tools in the market that helps us to make decisions. And that's one of the things we'll be talking about tomorrow. Yeah, so thank you very much, guys, for today's class, for attending, and just make sure you're able to download your MetaTrader 4 on your charts and start marking lows on the charts. Just mark 3 places. Any place you have 3 low, mark it. That way you will start understanding how these markets work better. So we'll be ending the session now. Thank you very much and see you tomorrow.
Thank you, sir.
Yeah, that's good. Yeah, welcome. Have a nice day.
Thank you.
Yeah, okay. This bootcamp is actually designed to give insights for people that don't really know what Forex trading is all about. So we'll be starting with some methodology today, and we'll be going into the main part of the trading tomorrow, which is 28. So I believe others that are even connected remotely and other sources are new to Forex in one way or the other. So first, I would like to introduce what Forex is all about. And if you look at the word Forex, it stands for foreign exchange, which means it's a business that involves buying and selling of currencies. So it's a part of Forex trading, which involves buying and selling of currency. We can either invest in Forex and we can also trade Forex. But in this training, we will only be focusing on the trading aspect of Forex. So when I started this journey, I actually did not know what Forex was real about. I was at the wrong part of Forex trading. More like gambling with Forex, getting scammed with Forex, got to wrong platform. Also, I choose the part of losing money. But suddenly, my mind shifted. I knew I was doing wrong thing in the market until my reflection changed the entire game. Because I believe and I've seen and I've gotten close to people that are making money steadily and willingly in this market. I had to tap from their energy. So something around the COVID-19 period was one of the biggest years of my life. I traded full time. When business were shutting down, people were complaining. I had a mind shift and everything clicked. And what many people were seeing as a downfall was felt like a blessing to me. I made much more than I've ever made, and since then it has been replicated to others. So trading is presented to 2 sets of people majorly. First, people are those that treat it full time. So when I mean people that treat it full time, people that have the right mind and knowledge, knowing that what they are doing is actually right. Because not everybody that is trading in Forex that are doing the right thing. And then the second set of people are those that jump into it without direction, without skills, without full knowledge about it. But since you are eager to learn, I already know what direction you are falling to. So first thing you need in trading, before you start Forex trading, is you need to have a phone or a laptop. And your phone has to be connected to the internet connection whenever you want to connect to the foreign market. So we are going to download these apps. So this session will be recorded for many people that can't able to join at 7 p.m. I know this time hour I have to shift it, but I still need to make my decision on 7 p.m. Yeah, but the session is recorded for other people that are planning to join later in the session. So for you to enjoy and get every ingredient from this bootcamp, you will have to download these apps on your Play Store or your Apple Store if you are an iPhone user. So one of the apps is the MetaTrader 4. We have here the MetaTrader 5. These two platforms are the trading platform where you are executing your trade, you're buying and selling. While we have another platform here called the Trading View. This platform will be used to analyze. This is where you make your decisions in the market. So you are making decisions fully from this platform called Trading View. Then you are making your execution, your trading, buying and selling from these two platforms. Then we have another platform here called Forex. So this is the platform where we'll be withdrawing our money. Any money we make, this is where we'll be withdrawing those money from. Then we have two other platforms. These two other platforms, I will be talking more about them tomorrow session. So let's dive into the real journey. So the methodology are what I'll be sharing with you today. So there are 20 things you need to know before you start clicking that buy or sell button or making money from market. So I'll be taking you through those 20 steps. So first, you need to understand what is Forex trading. So what is Forex trading? Forex is like making a trip from a country to another country. For instance, you are traveling from Nigeria to Bahamas. We can see the first two countries has to be involved. That means you can't carry out foreign exchange with just one country or one currency. You have to involve two countries. But we don't directly we'll be working with the countries, but in this sense, we'll be working with their currencies. So, for instance, you are traveling and making a trip from Nigeria to Bahamas. In Nigeria, we spend Naira, and in Bahamas, they spend Bahamian dollars. Since the country I'm going to is Bahamas, then I have to switch my currency from Naira to Bahamian dollars for me to be able to partake in any transaction or opportunity present in Bahamas. Else, I might not be able to spend my Naira or get anything useful at Bahamas with my Naira. Which means if you tender your hard-earned Naira to people of Bahamas, they will see you as a joke and ask you, what do you want me to do with this paper? Or they can even think at that period, the particular thing you hand over to them, they might think is useless to them because they might not be able to figure out what to use with it. So I also see Forex trading as a story or a country. All countries have their story. Meaning I look for which country is having the best time. Any country that is developing, that is doing well or having a particular event, I figure them out, then get involved with those countries by transacting with them. So if you look at this particular diagram here, this is the essence of forex trading in one visual. You have two currencies, the US dollar and the euro. The goal here is simple. We buy low and we sell high. Here we buy when the USD rate is low at 0.85. That means 1 US dollar buys 0.85 euros. Then we sell when the rate is high at 1.20. Now $1 buys 120 of euros. The difference between the buy price and sell price is where the profit comes from. So we are trading the relationship between two currencies, not just holding one. Remember, it's not about whether the dollar is strong or weak in isolation. It's about the pairs. We buy low, we sell high. That's the cycle, and that's the opportunity. So we said the foreign exchange involves two currencies. For instance, we have euro and we have US dollar. Look at this quote, 1.0850. This is an exchange rate you see in any bank or any time you want to exchange any form of currency. This is a currency pair. Think of it like a price tag. It means 1 euro costs 1.0850 US dollar. Below you see euro 0.25. That means the euro got a little stronger compared to the US dollar by 0.25%. When the euro gets stronger, the number goes up. If it was 1.0800 before, now it is 1.0850. So if you are holding euro, they are now worth more in dollars. And if you were trading a move like this, it could mean a small profit, depending on which side you were on. So if you can understand this now, it means you are now reading a forex quote. You can have a screenshot of this most traded currencies pairs. So these currency pairs are most traded currency pairs that even when you start trading, this is one of the currency you are going to start understanding. So take a screenshot of it. And it has to do with the currency pairs. You can see we have euro, US dollar, USD, JPY, and we have the country, and we have their nicknames. So all these countries, these are the pairs that are responsible for movement in all these countries. So one key terminology you need to understand in Forex is what we call a pips. Because this is actually where you know if you are making money or you are not making money in the market. So look at these two prices, 1.100 and 1.1050. In Forex, the smallest price move is called pip. In this example, the price moved from 1.1000 to 1.10450. and that's a change of 0.0050. So we count this as 50 pips in the market. You can think of pips as the point in a currency price. Trader who usually trade more often watch pips to measure profit and loss. So if you bought at 1.100 and sold at 1.1050, you have made 50 pips profit. And one thing you need to understand after you know these pips is grasping the concept of lot size. So if we are talking about lot here, in Forex, a lot is just your trade size. It means as a Forex trader, when you start trading, you need a form of capital to be able to connect with the financial market. It doesn't matter how small that capital is. It can be $10, $50, $100, $1,000, or even more. But for you to be able to manage that small capital you have or large capital, you should be able to know what to transact in the market. And that is where the concept of lot size come in. So in Forex, lots is just your trade size that you are willing to transact with. And we have three types of way you can use your lot size. Is either you use a standard lot. So a standard lot can be like you are risking the whole account, your whole capital. So it's more like a pizza in this dialogue. So a standard lot is like you are risking a whole pizza. Imagine having a full pizza and you are just giving it out. Then a mini lot is more like one big slice. How many slices do you have in a pizza? Let's say you have 8 slices. Then you are taking one slice out of it. That is a mini lot. Which means if you remove one mini lot or one pizza, you still have 7 slices left. So you still have 7 times you can still trade the market and still be profitable. While the third way to use your lot is called the micro lot. It's like a tiny taste from your slice. So you have a full 8 pizza, then you take one from it and you now have a slice from it. That means even in that one you can still be able to still have enough to transact with the market. So when you are just starting, we trade with the micro lot size. We want to trade small, trade safe, and easy to manage. That way you can learn without big risk. So remember, your lot size is simply how much you are trading. Start small, learn and grow when you are ready. So before we end the course, we are going to master how to use your lot size properly so you can make consistent amount from the market. So we have Forex trading strategies. Forex is actually designed for different people around the world. So there are different people that are full-time, some are part-time, some are also day traders. Yeah, so it depends on where you fall in, that is where you know how to trade the market. So trend following now, you can see is generally for people that want to invest, more like stock traders. You want to know direction of where to invest your money in. That is where trend trading come in. So the scalpers is like making quick decisions, small trades, going in and out in minutes to catch many price movements. This particular set of scalpers, they spend almost all the whole day in the market. We have range traders. These people trade bounces. They trade like highs and lows. They want to sell high, they want to buy lows. And we have the swing traders. So these swing traders, these are people that capture moves that last for days or weeks. They focus on waves in the market. So those waves can last for 4 days, sometimes 1 or 2 weeks. Then we have the news-based traders. These particular people focus on economic news and can shake the market. So when their strategy is dependent on the news, that means they have to be available for any kind of announcement. Just as I mentioned before, I mentioned that Forex trading is like understanding story of another country. So if a country story is doing well, it means a news-based trader can capitalize on that and can make money from the economy doing well. So news traders always focus on announcements and their platform to get this announcement. So let's look at this chart. This is the chart of Euro US dollar, Europe and United States combined together. We can see the word buy, which means someone is expecting the price to go up. When you expect a currency to rise, it's called being bullish. And when you open a buy, that buy you open is now a trade, and you can now call it long. So each of these terminology is driving to the same thing. When you buy, you are bullish. And when you are bullish, you are in a long position. It means that you are capitalizing on a buy trade on the market, and you are expecting the market to continue going to the upside. So at this top, you can see what is a price chart. At the olden days, what we used to look at the market is different from what we see now. Now we can easily understand the market and make decisions because we can see price charts. And on my right here, this is what we call a price chart. When you can see those form of candles and those waves that goes up and down. But on the left, a price chart story is telling us what happened in the market. It shows us the battle between buyers and also the sellers. So instead of reading paragraphs of news, we can look at a chart to see who is winning. Think of it like a storybook for currency prices. Each candle, each line tells us something about how traders felt and what they did. So whether you are looking at Euro US dollar or any other pairs, the charts help you understand what is happening on the charts, and so you can make your decision about the future. So this is how a chart looks like. Whenever you see any quote like this, it's a chart. It's telling you price movement. And in the chart, we have the time below and the price at the right side. So if you dive deeper inside the charts, you should be able to see market candles. I represent this as market moods. This is how I read the market, because I look at the market moods, how the market behaves. Then that is how I transact with the market. So on your chart, you see candle. Some are green or white, and some are red or black. A green candle tells us the buyers were in control. it means the price closed higher than it opened. And when you have a bullish candle like this, it means this particular candle is in a good mood, like it's in a bullish mood. It is happy, it is optimistic. But on the other hand, the red candle tells us the seller were in control. It means the price closed lower than it opened. So we are in a bearish mood. And a bearish mood now represents sad and pessimisticness. So every time you look at a chart, these candles are telling you a little story. The green means up, while the red means down. And that is how the market moods behave. When you understand the candlestick, each of these candlesticks in this place, as we mentioned, these are bullish candle and these are bearish candle. It means market is happy and is going up. It means market is sad and is going down. So if you can now start understanding what this chart is doing, there are three things this market usually represents. The three ways the market moves. The first is uptrend. This means price is giving you higher highs and higher lows over time. More like the market is climbing a staircase. You can see the market is going high in this area. It's going high. This is what we call an uptrend. The market continues to go high, low, high, low, high, low, and higher. Then the second thing you need to understand is the market is in downtrend. This is opposite of the uptrend. The price is lower. The price is making lower lows. Is making lower highs and lower lows. So in this sense now, the market begins to go down, diminish to the bottom, start going down. It's more like it's going down a staircase. Then the last thing the market does, which is the third thing, is ranging or consolidation. Here, the price isn't really going up or doing strongly going down. You can say the market is moving sideways. It's bouncing a top and bottom level. You can say this is what it does. Look at how choppy it is in this area. It's not giving on any particular direction. So in summary, we can say up is uptrend, down is downtrend, and sideways is ranging. And if you look at the market properly, the market doesn't move in straight line. It does what we call impulse and correction. So this slide you can see here is showing us that market moves in waves. It doesn't move in a straight line. And we have two types of move. One of the move is what we call impulse phases. And this is a strong move in one direction. When the buyers or sellers take control and push the price strongly or up to the downside. Then we also have the second move, which is correction phase. Whenever you have a strong impulse move, what comes next is a correction move. The market often makes small breaks or pull back a little, which are called correction. It's like catching its breath before the next big moves. So think of it like running up a hill. The impulse is when you sprint up. The correction is when you pause or take a few steps back before you go again. So in this market now, you can see we have a push to the upside. Market corrects, impulse, correction, impulse, correction. So we see overall, the market is moving in a uptrend direction. So one other key thing you need to understand before starting to trade is what we call candlestick patterns. So I'll show only 2 candlestick patterns in today's class. And this candlestick pattern is a bit dramatic. So we call it bearish engulfing pattern or bullish engulfing pattern. We can look at this candle now. The first small green candle. It was looking bullish. Then the next candle opens, but it doesn't just open a little higher. It opens at above where the last candle closed. And here's the twist. The sellers take over right away and close this candle below this candle. So this red candle is engulfing this bullish candle. So this red candle goes down so much that the whole body completely swallows up the entire green candle before it. It opens high and closes low, way below where the green candle opened. So what's the story here? It's like optimism getting ambushed. So if buyers thought that they were in control in this candle, but sellers said no, not today. So when you see this on the chart, especially after an uptrend, it's a strong sign that the trend might be reversing. It means the bear have taken control. You can see the picture behind this candle is a bear. So bears take price down. And this, we have bullish. It's opposite of the explanation here. We have a bearish candle, then we have a bullish candle. So this is the candle pattern you have to put in your mind. This is still an example of bullish and bearish candle. So the second candlestick pattern you should understand is the shooting star and hammer pattern. So this is a shooting star and this is a hammer. These candlesticks are represented when you are looking at the chart. At the top of the chart, if you're able to spot any of these candlesticks, it's likely that price is getting weak and the price might likely start to change direction. So these are what we call rejection candlestick. It means there is an indecision in the market whenever you see this candlestick. Something must be happening somewhere that makes this candle behave and have this kind of pattern. So this is the body of the candle. This wick you are seeing, this long line you are seeing is the wick. It's the wick of the candle, and this is the body of the candle. So it has a small body with a very long wick. It means an indecision is currently in the market. And you should pay attention to this type of candles. So how do you put everything we have spoken about together? And that is where technical analysis comes into play. So let's keep this simple. Have you ever looked at a cloud and seen its shape? that is look like a dog or a face. Technical analysis is a bit like what I just explained. But now we are now seeing it in a price chart. We look at the lines that are showing and the little candle shapes on the chart. We are trying to spot if we'll be able to see patterns that has happened before. And why do we do this? Because traders are people, and people often do the same thing when they are excited or scared. And the reason why market goes up and down is because there are people transacting in it. So if a price fell, if a price come down to a certain level, then bounce up 3 times in that particular level, traders will recommend that level the next time. There are easy tools we use to understand this better, like a trend line. We can draw a trend line on the charts. We can use simple candlestick shapes. And we can use some mass indicators like that we have on our trading platform. So in short, technical analysis is finding familiar shapes and patterns in the price chart to make a trading decision. We are not actually predicting the future. We are just looking for clues from the past. So we are going to be applying how to use technical analysis when we dive into the chart. So let's learn your first and most important tool in trading, which is part of support and resistance, part of your technical analysis. And this is your support and resistance. So in this diagram, you can see this place is like a top of a room, and this is like a bottom of a room. So we think of the market like a room. Every room has a floor and a ceiling. And in this scenario, we are saying the market is moving around this room. Since we know market has a room has a ceiling and also a floor. So we want to see market moving in this room. So the resistance is the ceiling part of this market. It's a price level where the market seems to say, nope, I can't go higher right now. Which means if market can't go above this resistance level, then the sellers can step in because they think it's a good price to sell. So this line near this top is the resistance. When price comes to this line at this top, it is a ceiling. Price cannot go above it. The only thing price can do is to fall down. And that is where we traders are planning to sell from. Then the next one is your support at this down. Support is the floor. It's a price level where the market says, hold on, let's not go lower. Buyer steps in because they think it's a good price to buy. So this line here now represents a what? A support. And when price comes to this support, is the only thing it can do is to bounce to the upside. So price bounce between these two levels over and over and over again. Every time it touches the ceiling, it often falls back. And every time it touches the floor, it often bounces up. So here's the trader thing we put in our mind. We buy near support and we sell near resistance. So we are just buying from the floor, we are buying low, and at the ceiling, we are selling high. That's basic what we do foundationally. So I've just shown you one major tool that all traders uses in Forex, which is the support and resistance. And the next tool you need to now understand is an indicator. This is a basic indicator we call moving average. So this is your first indicator. So imagine your chart is like a road. And at that period, you can't see the road clearly. You're having issue navigating the road. A moving average is like taking a paint or a bulb or smoothing or bumps to be able to clean the road for you or shine a kind of light for you to see the road properly. So what it does in the market, it shows you average price over a certain time. And now here's how it works. It works really simple but very powerful. For instance, you have a candle above. If the current price is above the moving average line, the trend is generally up. And we call that a bullish signal. And for a bearish signal, if the current price is below the moving average line, the trend is generally down. In this aspect now, if the market is currently above this line, it is down. So you are thinking of it like this. Is the price walking above the line? If yes, then you are in an uptrend market. Or you ask yourself, is the market or is the price walking below the line? Then you know you are downtrend. So one of the most famous moving average is the 200-day moving average. Some traders call it the bull or bear line. It means if the price is above this 200-day moving average, 200-day moving average, if the price is above it, the long-term trend is automatically up. And a lot of stock traders or investors uses the 200-day moving average to make decisions on their assets, maybe on cryptocurrency or their stock. So if the price is below this 200 moving average, it is a downtrend. We all know investors don't usually sell, but they make decisions to only buy. So there are some few things you can use with this 200 moving average to give you a perfect investment opportunity that you can make decisions on your own without relying on any other person. So moving average help you see the direction without getting distracted by all daily ups and downs that the market is showcasing. We can see in this particular chart, this is a 200 moving average. And this is a candlestick I explained before. You can see short candlestick and long candlestick. This candlestick can be in different color, but we need to understand how they behave, the emotion they give. And the emotion they are giving right now, they are telling us price can only go up. So the trend direction is uptrend. And even without understanding the trend direction, with application of this 200 EMA, moving average here, we can see when price touches this moving average, it bounces to the upside. And now it's touching it again for the second time. There's chances that it will bounce again to the upside. So what this moving average is telling us is it's giving us an insight and direction of where the market is heading to, the trend direction it is going to, and it's also serving as a support to our trading. which means if market bounce on it, it's serving as a support to go to the higher side. It's serving as a support to go to the higher side. So this is a meta trading platform. This is one of the apps we use in trading the financial market. This app gives us access to the financial market, which means I can execute trade on this platform. I can buy, I can sell. Everything we have learned today, we can apply it on this market. But first, we need to understand how this trading platform works. Okay. So I'm going to be giving a sneaky peeky snippet on what this market does. Then tomorrow we are going to show you how to actually navigate and how to make decisions by yourself in this Forex market. So when you open this market, this trading tool is called MetaTrader 4 or MetaTrader 5. You can go to your Play Store and download it on your phone and on your laptop. So without this tool, you can't really take any trade in the market. You need to connect your broker to it. This is my broker, which is HF Market. This is a demo account. This is a live account. So once you connect your broker to it, I'm going to explain more about broker tomorrow. But once you connect your broker to it, you now have some access to money and what we call leverages to trade the market. And the leverage you are having access to is for you to be able to trade big amount of money with your small capital. So you need to have peers that you trade with. These are the peers. We mentioned some that currency we can't trade with just one currency. We need one or two, at least two currency before we can make decision. And in trading Forex, we only work with two currency. And we can see we have different currency here: GBP USD, Euro JPY, Euro AUD. These are different currency pairs, different countries. So XAU US dollar is gold against US dollar. GBP US dollar is Great Britain pound against US dollar. Euro JPY is euro against Japanese yen. So you can see the Europe country and also the Japan country. Yet we have time frames here. You can look at different time frames depending on the type of person you are. And we have tools. And this is finally the chart. This is what I explained initially, the candles and also your moving average. So this moving average now is giving me indication of where to buy and sell from. So first thing you need to do is go and download your MT4 in your phone and on your on your laptop if you have a laptop. Then make sure you are able to look at your charts, understand your chart, and also understand the peers. And we'll be finalizing the class now, so we can continue by 7 p.m. tomorrow. All right, thank you guys for attending. Yeah, see you tomorrow.